Good morning, everyone. This is Amit Pabari, founder and managing director of Forex. Every week we are hearing that some or other banks in the world is falling. Last week there is a doubt that Deutsche Bank is in problem. Now let us see if the banking crisis continues, what impact it is going to have on different asset classes. History is my favorite subject, and history tells us what has happened in past. So if you see the chart, at any point of time, whenever there is a crisis, subprime crisis, dot bubble crisis, every crisis, gold has moved up. So we can say that the gold is the next thing to invest. In the month of November, we released a video saying that we are expecting the gold price to move higher towards $2,000 per ounce and 60,000 in Indian terms. Now we are upgrading our target to the next level, $2,300 per ounce in international terms and 66,000 in Indian terms. The next common thing in every crisis is that the dollar gets stronger. If you see the chart, all the crisis dollar has gone higher. So currently we are expecting that DXY should move higher towards 105 level, euro should move towards 1.05 level, and pound should move towards 1.18 levels. So coming back to the outlook, in the middle of the crisis, we can conclude that gold and DXY will go higher. Equity market across the globe should underperform and emerging market currencies should get weaker. Coming back to rupee, because of year-end flow, the pair might get appreciated towards 81.80 to 82.20 kind of a level. But looking at the global crisis, we are expecting that any dips will be on a temporary basis and the pair should again move above 82.70 level. Ideally, the overall biasness of the pair remains on the weaker side and 83 should be broken after 31st March closing. Now let us discuss strategy for thin margin exporters. Most of the thin margin exporters have taken costing between 82 to 82.20 level. They should cover 50 to 70% of their exposure between 82.40 to 82.70. For the remaining position, they can target 83. If someone have taken aggressive costing of 82 and a half kind of a level, they should not panic to sell at lower level. Instead, they should wait to cover above 82 and a half level. Ideally, they can target 82.70 to 83 kind of levels in coming days. Now let us discuss strategy for thick margin exporters. History has taught us that when global scenario looks gloomy, it is advisable that we keep our hedge ratio on a lower side. So there are two strategies for thick margin exporters. Strategy number one is, if their costing is less than 81 and a half kind of a level, then ideally they should keep a hedge ratio between 40 to 45%. Second advice to all thick margin exporters is that they should not cover based on anticipation of order, because premiums are unattractive, and if the crisis increases in coming days, then exporters will have two scenarios. Scenario number one, weaker dollar rupee pair and lower orders. Now let us discuss strategy for importers. The simple mantra for importer is that any dips has to be taken as an opportunity to buy. Between 82 to 82.20, if they should be ideally covering their 1 month import. And if the pair moves below 82 level towards 81.80, then they should take advantage of it and buy imports for 2 months, either by buying via forward, or they can move towards option by buying at the money call option. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.